Hey yo, it's your favorite YouTube host on most things real estate. My name is Mohammed. I'm a real estate investor. I'm a realtor. I'm also a host of this YouTube channel. And YouTube tells me that if I actually stop and ask in my videos for you to like and subscribe, if you're enjoying this content, please go ahead and drop a like or just subscribe or even maybe a dislike, because then it'll help this video reach the people that are actually looking for this information. With that, guys, I just want to share a quick story with you. So a few weeks ago, one of my clients and I, we stumbled across a listing that was amazing. Everything looked really good on paper, and one of the options that the listing agent gave in terms of financing was seller financing available. Up until this point, I've heard the term before, but I have never actually had a chance to interact with it in my day-to-day experiences. So my client asked me, hey Mo, what does that actually mean? And I told him, hey, I actually have no idea, to be very frank, but I can find out for you. That's why I stopped, did some research. I'm making this video. I also wrote a blog post about it. And if you don't want to watch the whole video, definitely scroll down, click on the link in the description below for my blog post where I explain exactly what seller financing is. But for some reason, if you like hearing me and watching me, then stay tuned, because let's jump right into it in terms of what is seller financing. Now, if you haven't figured it out yet, seller financing basically means the seller finances the purchase, and that's the end of the video. We can all go home now. But wait, there's more. What does this actually mean from a buyer's perspective and the seller's perspective if the seller is the person acting as the bank for the home buyer? From the buyer's perspective, it works out in a lot of different ways. A lot of times, home buyers might not have the cash available for the down payment for a conventional or even like an FHA mortgage. Sometimes as well, home buyers just aren't credit ready to purchase a house, and it makes it very difficult for them to qualify for any kind of conventional loan product. There's also the added notion that for buyers, it's a lot more flexible, because that means they can structure the deal how they want to structure it for it to best make sense both for them and for the seller, because you won't have as strict of an underwriting process as you would with, let's say, a conventional bank. However, from the buyer's perspective, there's also a couple of main things that I think you should keep in mind. The interest rate is generally going to be higher, which makes a lot of sense in my opinion, especially if the seller's financing it. The seller's taking quite a big risk on it. But the second point that's related to that is usually with seller financing, the loan isn't amortized, or I'm sorry, the loan isn't held for 30 years like the traditional mortgage note. It is amortized over 30 years, so the payments are technically spread out over 30 years, but there's usually a balloon payment that's due in like 5 or 7 years. And the logic behind that is that a home buyer shouldn't necessarily hold that seller financing mortgage or that seller finance note for the duration of the 30 years or even the 5 years. The goal is to always get their foot in the door, get the house under their name, and then refinance into a conventional mortgage in a couple of years when they're in a better financial position. For the seller, the main advantage here is it's a very creative way to attract more buyers to your house. So if you're having trouble selling it through the conventional ways and you're listing it and a lot of people aren't making any offers to it, if you loosen up your criteria, you're definitely going to get more interest from buyers. The one thing for a seller to make sure of, though, is if you are considering seller financing and you have a mortgage already on your existing home, then you definitely want to check with the bank first before okaying a seller financing option, because your mortgage holder might not be okay with it. Now, there's a couple of different types of seller financing available. One of the more common ones is assumable mortgage. What that basically means is the home buyer will take over or assume the existing mortgage for the home seller. So whatever mortgage amounts left or whatever balance is left on that home, the buyer will assume that and take over it. It'll be basically a mortgage transfer from the previous bank. And of course, if there's any other extra payments that the buyer needs to be making, they'll make that directly to the home seller. The second option in terms of seller financing is a lease option. This is very similar to like a rent to own kind of program, where let's say, for example, if I'm the home buyer and I can't afford a home, but the seller is willing to do like lease seller financing, I would effectively be paying rent every single month to the homeowner. And in return, one of a couple of things might happen. We might sign a note where after a couple of years, I have the option to buy the house for a specific price, or also that the rent payments I'm making are actually going towards, let's say, a down payment or towards that sales price, right? So that way I don't have to pay that full agreed upon sales price if I've been paying rent and the owner has been counting that towards the final sale price, which works out both really well for the seller and the buyer. The third option in terms of seller financing is a land contract. Now, what this basically means is the home buyer would have equitable ownership of the property, but they wouldn't be on the deed yet. What that means is on paper, technically, you own the house or you co-own the house with the original seller, but the deed's not going to be in your name until you've paid off whatever note you have with the original homeowner. The fourth type of seller financing is what we call an all-in mortgage, which is the most simplified version. Basically, the seller will finance the entire purchase for you, and you hold a mortgage note, or you're responsible for mortgage payments to that seller with whatever balloon payment or whatever structure you have figured out. The fifth and final seller financing option is the junior mortgage, where the seller does finance a chunk of the sales price, but you're still, as the buyer, getting a primary mortgage on the property. The risk, of course, for the seller there is, God forbid, the home buyer defaults. The original mortgage holder or the main mortgage holder is going to be the first in line to recoup any expenses or costs if they have to, force sale the house. Now, those are the different kind of ways of seller financing that currently exist in the market. If you like this video, again, please go ahead and like and subscribe. It really helps with the algorithm and getting this video out to other people that might find this useful. With that, guys, thank you so much. I look forward to seeing you guys next week. Have a good week. Bye-bye.